Hello, this is Alex Barnes with Cornerstone Wealth Group. Thank you for taking the time to join me today. In light of what's going on in the markets and most in particular with regional banks, with Silicon Valley Bank and other things going on in the news right now, we thought it would be timely to talk about what happened with Silicon Valley Bank, as well as some of the unique situations or circumstances they found themselves in, and talk about what FDIC insurance is, what it means to you as a client or somebody watching this, and then what solutions Cornerstone has to offer as a solution outside of maybe a regional bank that you may have some concerns with, you may not, but maybe you just want to diversify some of your holdings if you're worried about cash and FDIC insurance. So first off, let's talk about FDIC insurance. And FDIC insurance is for money deposited into banks that are insured by the FDIC. So this is a federal program, and you are insured for at least $250,000 per insured bank. So that is cash deposits. We are not talking about securities. We are talking about normal bank accounts. As you can see, we're talking checking accounts, savings accounts, money markets, CDs, things of those items that the FDIC is going to cover with that $250,000. What FDIC does not cover is stock investments, bond investments, mutual funds, life insurance. So if it's not a traditional bank account, checking, savings, or something of that nature, FDIC does not cover that. So that is something that is very different and was not part of what happened with Silicon Valley Bank. So Silicon Valley Bank was a bank out in California, regional bank, and unfortunately it shut down last week. Part of the Silicon Valley Bank's main clients were focused in crypto, venture capitalists, startups, and the majority of those clients held over $250,000 on deposit. So well above typically the FDIC insurance limit of $250,000 that was secured at that time. And for Silicon Valley Bank, the majority of their assets, they were held in government securities, particularly 10-year treasury bills. And a couple of years ago, 10-year treasury bills, as we kind of had discussed at Cornerstone and put out there for our clients, they were yielding about 1%. So what happened with SVB, or Silicon Valley Bank? Well, Silicon Valley Bank, because of the clientele they serviced, those clients in the last year, as interest rates rose, had to go through additional cash that they had on deposit. So when they pull that cash out, Silicon Valley Bank has to cover that withdrawal from its security. So it sells a security to support the cash being withdrawn by the entity. And this happens at every bank. So this is not something that is particular to SVB. It is every bank. They have government securities, treasuries, they have loans, they have all these ways to securely invest their assets as required and regulated. But SVB had the majority of their assets in government bonds. And that is one of the particular issues at hand, unfortunately, is that as interest rates rose, those bonds weakened in value. And that means they had to realize those losses. So more withdrawals, more sells, more losses. It was unfortunately a vicious circle that kept occurring. And with SVB and then Signature Bank, which unfortunately closed under similar circumstances, the majority of their clients, between 86 and almost 100% between the two, had accounts that were well above the FDIC insured limit and caused what is being referred to and is a bank run where clients rush to get their cash out. Now, fortunately, as of this recording, the FDIC and the Treasury has decided to cover or insure those deposits for everybody who had a deposit at the account. And this does not make whole if you had stock in SVB or if you're an unsecured debt holder, but it does secure cash for participants or deposits in the account. So what's next? Well, as of this recording, we have February CPI report came out this morning. That is something that we can discuss at a later time, but it is important to know that the Fed is going to be looking at that. And the Fed is going to be meeting later on this month, and then they'll have their next rate decision and policy meeting. And those are important because part of what happened with SVB and Signature Bank is going to have an impact on what the Fed thinks at their next meeting and potentially could impact their rate decision. Now, we are not trying to make a prediction on what SVB or this, regional bank crisis may have at the moment. But the good thing is the Fed stepped in, the Treasury stepped in, they're securing those who had money at the bank, as well as the fact that they are trying to make sure that everyone understands we are not running into the same situation that we had in 2008. This is very different, but we are keeping our eye on it to make sure that it does not become a systemic problem. Volatility in the markets, as we saw in the last couple of days, we will continue to see moves in the market, just like we have for the last year, ups and downs, but staying invested, per our recommendation, as well as, long-term holding, you want to make sure that you're not making a knee-jerk reaction to something that's happening in the market just instantly. So what can you do? Well, from Cornerstone and our perspective, we have FDIC insured deposit accounts through various institutions and our partners, as well as we have an option that allows coverage that exceeds standard FDIC insurance for the convenience of your funds being held at one depositor. How this is accomplished is your funds are spread out over multiple banks to essentially increase your FDIC insurance by taking advantage of the $250,000 insured limit through various sources. If you do want to talk about these solutions, please reach out to us. We'd be more than happy to discuss that with you, as well as the rates that these are paying, which are very competitive in the current rate environment and the market that we're in. Additionally, this is a great opportunity to really think about making sure that you are properly diversified. If you are thinking about doing some financial planning, that you're keeping track of what your plan looks like, what would happen as rates rise or if they fall at this point. What if everything was in one stock, as we've seen in previous drawdowns in the market? This is just a great time to go back and revisit that plan and make sure you're still on the same track. If you do have additional questions, please reach out to us. We are here as a resource. We are happy to help you, and we look forward to talking with you soon. Visit our website at cwgadvisors.com, as well as check this video out along with others on our YouTube channel and our social media accounts.